Yeah, go right ahead, dude.
Yep.
Thank you.
Cool. All right. Let me share my screen here. Let's see. I need to allow the system preferences quick. I might have to quit and rejoin
Oh, no
to
problem.
where you
Was
guys
that
could go
was
without me.
was Thomas Thomas, were you asking? Thomas Rush, were you asking if you wanted to go?
Yeah, yeah, more than happy to.
Awesome, man. Thanks so much.
Yeah, of course. Come on to the live screen. Say hi to everybody. Cool. So I'm going to cover today Maple Finance. So I didn't write up a quick bio, but just to give everybody the background, work at Consensys Mesh used to be, work with my previously esteemed colleague here, DeFi Dad, there before he left for Open Waters, and so good to see you, of course. And then where I focus on in Consensys Mesh is effectively our equity and token portfolio, primarily on our token portfolio itself. So, we have a portfolio of around 130 positions. I manage 20 of those in terms of the equity side of the house, and then oversee our overall token portfolio and how we manage that, whether it's everything from yield farming, staking, governance, because we're obviously relatively substantial holders in some of the projects that we incubated in the past, et cetera. So that's me in a nutshell. Also involved in a number of DAOs and other side projects for fun. So diving into Maple Finance, I think Maple's really particularly interesting because it's, from my perspective at least, it's a standout in regards to the model they've taken and the target market they're going after. It's it's not a yield farming protocol. There's, I mean, technically, I guess you could categorize it as that. There is a Maple token, and you can farm it, etc. But in the sense that it's not almost a derivative of underlying financial products. It's not a kind of conglomeration of other financial machinations. So what it actually does, instead of all of those things, and it's obviously not to be disparaging of anything else, just a totally different approach, is they're really focused on real world institutional loans. So effectively, to oversimplify it, they're crowdsourcing DeFi capital and lending that capital out to institutional borrowers. Right now they're kind of early stages. There's two pools. It's USDC only, so it's a single asset. And then the element that I think that will potentially either make or break the protocol overall is the fact that the pools are operated by pool delegates. So these are people, typically some sort of finance professional. It's kind of like the Aladdin Bulls, in the sense that they're coming from professional experience where it lends itself to serving in that role. And those pool delegates effectively do the due diligence on the borrowers. So they look at everything in terms of the risk profile, how much they're looking to borrow, and I can get into actually a little bit more of that detail later on. But they're effectively the loan officer in this scenario, to pull in a real world metaphor. Like I said, towards institutional borrowers are so large amounts effectively, and there's a 90-day lockup, which is really just because they need a certain amount of stable liquidity to make these large loans to institutional borrowers that also then have lockups, right? They're using the capital not on a daily basis, but on a longer term basis. So you can see right now they have around 170 locked up, and that's just across the two pools. And then those pools are pretty heavily utilized. It's not in this screenshot, but basically over 95% of the pools are already allocated to borrowers. So it's money that's out there in the again, quote unquote, real world, that's being utilized. One thing I noticed right off the bat, though, is the borrowers are heavily crypto native. So a lot of these names people would probably recognize if you're in the weeds on just the institutional crypto side. I ran analysis on the pool that I'm participating in, and analysis is a strong word, but looked at who the borrowers were. I'm pretty sure 100% of them are crypto. I've just never heard of Vexel and couldn't get any information on them. And then the interesting element is they are, quantitative traders, market makers, sometimes venture funds, sometimes they have a multi-pronged strategy. And I was going to loop back around to this, but the great benefit of this is effectively you're lending money to these institutional borrowers, and taking the example of Wintermute, they're a market maker, so they're out now putting that capital to work and creating liquidity on the DeFi protocols that we all use, I assume, daily. So we're actually making you're generating a return while also making the larger DeFi markets more efficient, which I think is a really just great virtuous cycle in the sense of their model. And then going a little bit further just down into the how it works, it's pretty straightforward, right? You deposit USDC, you get your Maple token back to similar to like almost a compound token, and then you can restake your Maple token for a share of the rewards, and that's kind of the yield farming-esque version of it that I was mentioning before. Then I think in terms of like analyzing this as a protocol and looking at it as a investment opportunity, the one thing that I think is more unique again and kind of separates it, at least in terms of the mental model to use, is, for the most part, you're looking at these types of things for any given DeFi protocol or crypto project, right? Like all the typical stuff you do in startups, but then you also have some elements around smart contract risk, the protocol design, network design, et cetera, as well as what moats do they have that are unforkable, whether that's liquidity, community, et cetera. And so those are the typical ones, but with Maple, you have to tack on the fact that you're really leaning on the expertise of pool delegates, and then there's a risk of borrower default. So if the pool delegates aren't doing their job, that's obviously a risk. If they're lending to borrowers that are highly risky or outside of what you would prefer your risk profile to be, that's an added risk. So it's certainly like a couple of other layers of risk on that side. However, on the flip side, you do have kind of, like I said, the real world capital being utilized. So I threw a couple $100 into the pool that Orthogonal Trading is managing, and I think so basically I'm dependent on them, right, in terms of performance and everything. And going back to the previous page, you can see they were doing as expected. Last I looked, there was $0 in defaults among the borrowers, and they're pretty substantial borrowers in terms of their capitalization and everything. So I don't expect defaults to arrive anytime soon. And I think there's a few benefits. One, just generally the protocol reduces the barrier to entry. There's obviously access to DeFi capital for institutional borrowers, which is great. It kind of builds more bridges between the two worlds. Granted, most of the institutional borrowers are still crypto native as of today because they're just getting off the ground. And then your yield is based on the actual revenue of a real set of diverse companies, of a diverse portfolio of companies. So versus just, I think it ties nicely to the sustainable yield from the previous question. This is, I would argue, is more sustainable than the kind of the potential farm and dump models that do exist, and that we're all aware of. At least there's that risk of farm and dump, whereas this is much more based on again, the revenue of a number of protocols, depending on how kind of deep down the chain you go, in terms of where that capital is flowing to. There's also a few other side benefits, and I'm wrapping up soon because I'm pretty sure I'm up on 5. One, they're working on, or they're executing under collateralized loans. So kind of the current state is you're borrowing less capital than you already have, and obviously there's some arbitrage, and there's reasons that obviously makes sense, and but they're under collateralized and leveraging reputation and other traditional business and traditional finance metrics to make those loans. So ultimately, we're able to grow the pie faster through this model. And then what I mentioned before around expanding DeFi, because these market makers are participating in protocols. And I think in terms of how I would analyze it, I think going through the kind of the basics, right? What's their incentive system? What's their network and protocol design, tokenomics, et cetera. But then diving deeper into looking at the historic performance of those pool delegates, their ability to assess risk, their ability to attract and analyze borrowers, and then of course the borrowers themselves. You need to do the due diligence as well if you were to really go deep, as if you were a loan officer at a bank, to be again kind of oversimplistic. And I think there's a few recommendations on how they could improve it. And primarily it's based around the idea of increasing transparency into the states of each loan, the states of the borrowers, where that money is placed. I mean, there's a limit, obviously, in terms of confidentiality in those firms' trading strategies. They surely wouldn't expose that information publicly, but that information would be really helpful from a diligence perspective. So there's a balance to strike there. So yeah, I'll stop there and kick it back over to DeFi Dad and the rest of the crew.
Hey, thanks, Thomas. Does anyone else have any questions?
Yeah, I had one
By the way,
actually.
I'll just affirm I've used Maple. It is it's a really impressive protocol, and just I mean it's just a crazy concept that is unique at this point, that you can lend the way that you normally lend in DeFi, but you're lending stable coins to these vetted crypto institutional borrowers. The only drawback I could ever find with it is what Thomas called out with. There is a 90-day lockup. It used to be 180 days. It recently got reduced. So question is will that continue to drop with the amount of demand there is for folks to lend to these crypto institutional borrowers? So sorry, was that Sid that had a question?
Yeah, it was me.
Yeah, go right ahead.
So what kind of yields are you seeing on Maple compared to other like lending protocols like Compound or Aave? Like what is the kind of mix of yields there?
So the yields are around 20%. So depending on your obvious risk profile, risk return profile, I would imagine most of the people on this call can go chase yields that are higher. And I think I don't look at it as quite a fixed income product, not quite to that level, but I think it's 10% USD and then half in Maple, depending on the pool. So it is, I think, lower than the typical kind of market, higher than Aave and Compound, depending on where you're placing your USDC, but likely higher because you are getting those Maple rewards. And then lower than the other more degen stuff. So I think it's kind of a good middle ground, and I would probably place it without having done really deep analysis on the borrowers and everything, kind of to what I was saying about the diligence. I would certainly place it in the much lower risk bucket, because the capital gets so diversified both across where the borrowers are placing it in the DeFi ecosystem. Then that capital, a level up, is placed across 12, 15 borrowers. And then of course the pool delegates have done diligence on them. So it's de-risked in a number of ways, which personally I really like. I mean, I'm not going to put all my eggs in that basket, of course, but yeah, that's where it stands today.
Yeah, I think this is a really interesting project. I mean, most of the institutional borrow activity is like much larger than what we see in DeFi. To a large extent, Genesis, Celsius, and so on, they have large books of capital loans that they're dishing out. So this is giving access to DeFi users in a way that is like novel and different. So I think it opens up access in a lot of ways to the institutional side, which is actually huge.
Completely agree. I didn't even touch on it, but and I don't know Maple Team's finance plans. I've been in there harassing them in the last 2 days in prep for this, and they haven't gotten a ton back to me, rightfully so, because they're busy. But I'm curious to understand if they are able to really build a scalable model that has X number of automations built in. Can they also kind of go quote unquote like down market to more to lower dollar amount institutional borrowers? So, is there a world where in 5 years this is targeted towards small businesses, and a small business is able to come to Maple, obtain a relatively low APR loan from a business where maybe they wouldn't be able to get one from a traditional bank, or perhaps there's markets where the traditional banking system is obviously like subpar, and then those borrowers could come to Maple. I think there's a huge growth potential for them on that front.
I think that's it. Anyone else have a question for Thomas? Awesome. Hey, thanks, Thomas. That was great.
Thanks all.
Anyone else keen to go next?